Hey guys, good morning. Okay, so just before we get started, a quick reminder. It's a webinar presentation. That means you should be receiving sound and vision, which in turn means that it probably uses a fair bit of bandwidth. So if you do have any trouble with the quality of the sound, by all means do send out an alert, but if you can make sure that any other applications you've got open, maybe you've got a Twitter stream open or any other application that's using the web, if those are closed down, then generally you tend not to have those kind of problems. Okay, let's get started. It is the 7th of January 2013, so welcome back everyone. Hope you've had a great break and managed to do all of those things that you've been putting off pretty much the whole year because you were so busy trading. I know certainly on this side we had an opportunity to take have a little family holiday, but come back to a heck of a lot of DIY, and all the jobs which are half done will probably now have to wait until the Easter break. So I guess the missus isn't going to be too happy about that. But you know what? We've got the best excuse in the world, right? We're traders and now we're working. Okay, quick look at the data front. On Thursday, we've got the Bank of England with its asset purchase facility announcement and the key interest rate decision. On Thursday, we also have interest rate decision announcement from the ECB. And between now and then, there's not a lot on the calendar, but data releases mostly seem to be dominated by industrial output and international trade balances. Okay, let's turn our attention towards the charts. We're going to look this morning at the majors, so we'll look at the USD JPY, Euro USD, GBP USD, and the Swissy. We'll take a quick generalized look at the yen crosses, and then we're going to take a look at our favorites, the Euro GBP, Pound Swissy. We'll also take a look at GBP AUD, which is pretty much where we left off the last time at this presentation, which I think was on the 17th of December, so way back, almost 2-3 weeks, right? Okay, actually before we do that, if you're looking at my screen, this is the USD JPY. You might notice that there's a big orange line going across the screen, and if you're looking at all of my charts this morning, they all have this kind of big orange line marked on them. So that's the GBP USD. We've got dollar Canadian, the Aussie, the yens, and if you're looking through those screens, they've all got this big orange line across it. What that orange line is the closing price on the 31st of December, and on some occasions it represents the opening price on the 2nd of January. And from a quantitative perspective, which is how I tend to view the charts very early on in the year, if you would close your eyes, or you don't necessarily have to close your eyes, but if you were to imagine that there is a thing which is called a yearly candle, so it's a candlestick but on a yearly time frame, and this candle looks just like every other candle, right? So it has an opening price and it has a high and a low, and it also has a closing price. Well, the opening price of any candle tends to be the price that tends to be the level that price tends to move away from, right? So as traders, we're always looking for those levels, and sometimes we miss the most natural or sensible levels to be considering. But the yearly open is one of those levels. If you consider any instrument, any currency, any pair, it doesn't matter whether you're looking at the forex or the equities or the indexes, there is a yearly open price, and if the price didn't move away from there, then trading as an industry would collapse, because it would mean that nobody's making any money. So price does tend to move away from this level. If we consider the average range, or if we consider the kind of annualized range that any particular instrument has in the forex market, if we're looking at the majors, even if we're looking at the driest of them, over the course of the year they tend to move at a minimum at least 1,000 pips away from the 1,000 pips away from the opening price. If you're looking at something like Euro USD, you're looking at 2,000 pips plus. If you're looking at something like GBP USD, you could be looking again at around about 2.5, or the greater part of 2.5 at least. What it means is that if you get involved in a trade early on in the year, using that yearly opening price in order to establish your bias, you could potentially end up building a position as the price moves away from there, and in the first 6 months, which tends to be the kind of cycle time, or certainly it has been over the course of the last few years, and in fact if we're looking at the monthly charts over the last few years, what you'll realize is that over the course of the last 3 years we've just been in this massive range, right? And that's pretty much across all of the majors, and as well a lot of the commodity crosses too, although it may not necessarily reflect the commodities against the dollar specifically, but the first 6 months of the year it tends to cycle in one direction, and then the next 6 months of the year the price tends to cycle in the opposite direction. In fact, if we just have a quick example of this, and we take a look at the Euro USD, I believe on the Euro USD, on the Euro USD, I'll just turn towards the daily chart, and if we're looking at the price which was on the 1st of January, on the 1st of January 2012, we're looking at a price region of roughly round about here, and what happened is that the price broke north, spent a fair bit of time above the level, broke south, and then returned to roughly near that opening price, right? So just kind of a quick demonstration of the principle. And if you look, and if you can't kind of imagine what I'm talking about, but if you just go and look and draw a horizontal line on the 1st of January on any instrument, you'll see just straight away what I'm talking about. Okay, so this is the line, this is the level that I'm using to establish bias. What it means is that if the price is above the level, then I'll be looking to be buying, generally speaking, and if the price is breaking below that level, then I will be looking to be selling. I'm not in a habit of buying dips or selling rallies. So what would happen is that if the price is above the level and I see a break north, that is the point at which I buy, and if the price is below the level and I see a break south, then that is the point at which that is the point which I'm going to be selling, and I'll be looking to build a position over the course of the year using this particular strategy, and once she's moving in my favor, then I'll be looking to add a little bit and add a little bit more and add a little bit more, and hopefully by the time we reach March or April, those positions should be significantly in the money, right? So that's kind of general strategy which I have, which I use particularly at the beginning of the year, and I also apply similar strategy at the beginning of most months after having selected a kind of pair which is demonstrating some form of momentum. Okay, that said, let's take a look at the let's take a look at the charts, and we'll start off by looking at USD JPY. We'll work through the majors, and then we'll look at the other pairs which I mentioned. Quite a straightforward bullish momentum visible here on USD JPY. From a structural point of view, I have a level here that she's hitting the underside of a trend wall, and I would very much suspect that, considering she's rallied so significantly over the course of December, And quite often we find as well during the month of January, January tends to reverse a lot of December trends. It's not a specific entry technique. It's a little bit of a rule of thumb. It's a general observation, but we do find quite often if you have a strong rally in December, then January tends to reverse that rally, and that is something that I'm going to be looking out for on the yen crosses, considering the strength of the moves that they gave during the tail end of December. As far as key lines and levels are concerned, well, you can see the 86.47 is marked on my screen, and that represents the yearly opening price on the USD JPY. Ordinarily, when we've seen price breaking north, until we get an SR flip, and we haven't had that on this instrument yet, we're not going to be keen to be shorting, although I do believe that she's close to a level. Rather, we still want to be aware of where the supports are in this rally, and if I'm looking for the more significant levels, then I'm looking at the 85.40, 85.50 area, which comes in around here. So it's coming in around the 85.60. There's a support cluster there. After that, we have support 84.60. And then there seems to be quite a significant level at around the 82.80 area, and that extends all the way down to about 81.60, right? So there's 120 pip odd cluster here on USD JPY, and I do believe that that is where the most significant support in this instrument is going to be. As far as the nature of this rally is concerned, it does seem to be demonstrating a fair bit of motive. So if we were talking about buying the dips on this instrument, I guess that would be quite fair, based upon the most recent structure. It's starting to look now as though, if we're looking at it, if we're looking over the duration of the last 4 or 5 years, the sellers were always forgiven on this instrument, but rather it is looking a little bit now like the buyers would be the ones who are forgiven, right? So just something to be aware of. But we have our key levels there, and those are the levels that I would be looking for reaction on this particular instrument. The last time we were here, we were looking at Euro JPY at that time, looking for her to break north, and she ended up rallying north to the tune of about 500 pips. Specifically as well, we were looking at the GBP JPY, and at that time the price was sitting here around the 36 area, and I was shouting 40.44 with a view that this gap would be unlikely to close, and it would end up providing support. And again, she ended up rallying to the tune of 500 to 600 pips, pretty much in a straight line from that time. So all of these yen crosses are demonstrating quite significant momentum. They're hitting levels now where there is going to be potential to be looking for that counter trend trade, but it does very much depend on seeing a momentum break in that direction and seeing resistance develop, right? So I don't want to be selling this blind. If it gets sold, it's going to get sold at a line or a level, and nevertheless, if we're taking our annualized strategy into consideration, we have here on GBP JPY the annual open, which is coming in at 40.65, and on Euro JPY we have that coming in at 14.30. That is the level that needs to be used for perspective. The closer the trade is to that level, the better your rally is going to be, right? The more number of pips you have which are available to be captured. As far as those gaps are concerned, and I remember saying this last time, that you have conventional wisdom and you have actual wisdom. Conventional wisdom says the gaps need to be filled. Actual wisdom says, well, you know what, that doesn't always happen, right? So quite often you see gaps running away, and you see price running away from those gaps. That is what seems to be happening on these pairs. So even if we're using those gap areas as our markers. Either the price is headed towards it or it's headed away from it. If the price is headed away from it, then we'll continue to be buyers. If we see the price headed towards it, then at that point it would be safe to assume that it's going to fill, and at that point we would become buyers. On Euro JPY it did fill, but on GBP JPY it was kind of left wide open to the tune of 30 or 40 pips. And I know I was speaking to a few guys over the weekend, and they were saying, look, that gap is still there, we're looking for that gap to fill. And I would just say, just take a little bit of caution, right? So if you're taking short at or around these levels, still consider it to be a counter trend trade. There is nothing structurally right now which is demonstrating resistance. You only want to be selling really, or it's a confirmed sell once you have a resistance structure on your screen, and we're not seeing that right now. Okay, so if you're doing it, it's a counter trend trade. Just kind of bear that in mind, and that will allow you to position. Accordingly. Okay, Euro USD in a similar kind of vein. We have the 32 level on the Euro USD. From a technical perspective, I would say as long as the price is remaining below that 32 handle, then in my mind she remains a short using that annualized entry. But also we have a kind of technical trigger here, right? So it's equally possible that that move above the 30, I think that comes in around the 3180 area, but that move above 3180, we could consider that to be a false break through a previous resistance. Okay, if that's a false break and the price has fallen back down into the range, then it would only be fair to be looking for a continuation to the downside on this instrument. So this is just kind of taking into consideration the most recent momentum, the momentum that we saw develop to the downside last week, and saying, alright, I'm expecting a continuation of that momentum. If it happens that the price breaks above 32, then at that point this perspective changes, and I would become bullish on this particular instrument, right? So 32 is the level on Euro USD. As long as the price is remaining below that level, I'm net short, and I'll be adding to a short position. I won't be selling the rally. I'll just take a blind short, and if it happens that the price breaks down further, I'll add a little bit more, and if it happens that she breaks down further, I'll add a little bit more. If it happens that she ends up sub 30s and she's back into the 20s, and if she can end up in the mid 20s, then at that point I would start getting a little bit more aggressive with those short positions. In a similar vein, if it happens that she's above 32, then I'll buy a little bit, and if she breaks out, I'll buy a little bit more, and if she ends up in the mid 30s, I'll buy a little bit more, and then at that point you can really start playing that position, just looking for the continuation trade and looking for the annualized trend to sustain over the course of several months. There is a downside to this strategy too, which I guess I need to point out, which is that if it happens that the price ends up in a broadening triangle at that kind of level, then I guess that'll be a little bit freakish and it'll get a little bit scary. But taking 1 or 2 or 3 attempts at this, it's really not going to hurt, right? So the reward is worth it. The potential gain is going to be worth it. So making 2 or 3 attempts, not a problem. You just have to make sure you have adequate risk definition, and it should be all kind of good to go. But based upon the proximity of price to that level right now, I would be looking for the short trade. Let's turn our attention towards GBP USD. GBP USD again, we saw a fair bit of downward momentum over the course of last week. Prices down to the tune of 350 odd pips. I'm looking at resistance to be kicking in somewhere between 61.30 and 61.70. I like 61.70 in particular. I think if she finds resistance at that level, and it's a level that I would be prepared to place shorts on GBP USD. Again, that yearly opening price on this particular instrument is coming in at 62.40, and so again, from a technical perspective, as long as she remains below 62.40, I would expect for the price to move away from there. And if it happens that the price is breaking up above 62.40, then my bias would shift toward the long plays on this instrument. Dollar Swissy, the yearly opening price on that came in around the 91.40 area, so as long as 91.40 is holding, then it is fair and reasonable to be looking for technical long play on this instrument. I've chosen in this case to be playing the Euro USD, so I won't be initiating those trades on the dollar Swiss. Okay, let's turn our attention towards pound Swissy, and then we'll take a look at Euro GBP and the GBP AUD. As far as the pound Swissy is concerned, so just holding a little bit of a vanity position there from last year, but that position is acting as a reminder that my net bias on this instrument remains to the downside. We have a downtrending line here on the pound Swissy, and that is something that we've played on several occasions before. Again, as long as the price is able to remain below the downtrending line, then she remains a technical short. So I'm just waiting now to see her break down. Once I see the price breaking down, heading in the direction in which I want to be trading, then I will be quite happy to be initiating another position south on this instrument. The yearly open price is coming in at 48.50, so I guess once the price is broken down below that level, it should be quite a clear run from there, and I'll just add another short position. And again, if she continues to break, I'll continue to add. I am still believing, based upon the current technical setup, that there is a reasonable amount of room to the downside on this instrument. If it happens that she makes a strong break north from here, then I'll be out of the kind of vanity position around the 49.90 or the 150 handle. So she just needs to break about another 100 pips north to stop me out of that one. And at that point, I would be reconsidering. I would be reconsidering the options. So if she's going to break down, she needs to do it from here. If it happens that she ends up breaking north, then we need to kind of sit aside for a little while and just reconsider and see how the price actually chooses to play out. If we see support being established above that level, then at that point we could end up becoming net buyers of this instrument. But as it happens, as it stands, my bias does remain technically south on this instrument. I'm just waiting for it to break down, show momentum in that direction, and then I can start getting involved. Over the course of December, that original position was good to the tune of up to 320 odd pips almost. So quite a nice play on that one. Okay, the Euro GBP. Again, I am still very much net long on this instrument, and I have longs everywhere on this instrument, starting all the way down in the kind of 78 area, and over the course of December I continue to build long positions on this instrument. They're all pretty much in the money except for a position which I have coming in around the 81.40 handle. Now the plan with this one is starting to change a little bit, and the plan is changing because the price is not behaving in the way that she was expected to behave. It doesn't mean in any way that my long bias has changed. It just has me exercising a little bit more caution than I have done previously with this pair. My original expectation for the pair was that once the price broke north, we would have a double bottom here at 79 at the kind of 79 area, 79.50 area. Once that happened, my expectation was that the price would break north and that the price would continue to break north without any kind of significant pullbacks. All right, that was my expectation. Now, as far as the price behavior stands at the moment, where she is now, I would guess that expectation is still pretty much intact. Right, so I'm quite happy with where the price is right now, which is why my long positions are still open on this particular instrument. And if it happens from here, and again we've got our yearly opening price at 81.20, if it happens from here that she ends up breaking north again, if we're seeing her move above the last high, particularly if she heads above the 82.50, that would have me adding another position blind, and if she moves above 83, I would add another position blind, and probably every 50 or 60 pips I'd be quite happy to be adding another position until she reaches around about the 85 area, at which point I would close out all of the added positions and just maintain a vanity position as she pushes through or surges through towards the 86, 87 handle. However, you have to have a plan B, and I have something which is, it may not necessarily be a plan in itself, but it's more of a kind of option B. If it happens that the price ends up breaking down from here, and what I've done with those added positions is that I've rationalized them. In any case, I rationalized them before the end of the year by taking a few chips off of the table. But if the price is falling, then I am not a buyer. Right? That's what's important here, because I had an expectation about how price would move. I've capitalized on that expectation since August. The original position that we're in were initiated around this kind of 78.50 area, and so we've capitalized on this long moves since August, right? So for the best part of 6 months. We were quite happy that when the price was dipping we were buying, because structurally we had an expectation and the price continued to move according to that expectation. And now she's at this kind of halfway house. What we really need to see her doing is actually breaking north now. If she breaks north, I'll be happy as Larry. She needs to go and head up through 82. She needs to head to 82.50. We can start adding. But if it happens that she starts breaking down, I'm not buying the dips on this instrument. No way, Jose. If she's breaking down, just let her break. If she ends up back at 79.50, let her sit at 79.50. If it happens that she ends up breaking down below 79.50, then the whole of this analysis becomes invalidated, right? So at that point we would have to reassess the situation and say, okay, is there a different pattern which is playing out here? Is there a different structure which is playing out here? And at that point we would in all likelihood be changing our net bias on this instrument, looking for resistance to be established, and then if there's resistance to be established we would be selling into that resistance, right? So right now we're still in that mode of buying support, but we do need to start seeing a rally, and that is what would give us the greatest confidence in what we're trying to achieve here, right? So where she is now, if you're buying, fine. If she breaks north from here, you're buying, fine. If she's dipping and you're buying, I would say exercise just a little bit of caution. We were looking for a double bottom at the 79.50 area. Then after that double bottom, we really were looking for her to make a straight break and head into those mid-80s. I was looking for a sustained rally. That doesn't seem to be happening. It's okay. Patterns do have their nuances, and although the general wave structure tends to remain the same, you do find that sometimes the price action evolves a little bit, and maybe that's what I'm looking at here, right? So if she breaks north, I'll be adding onto my buying positions. If she's dipping, I'm not buying the dips. If she falls below 79.50, then it's game over as far as the analysis on this particular pair is concerned. Alright, let's take a look at the GBP AUD. We want to take a look at the GBP AUD because we were looking at this pair the last time we were here about 3 weeks ago, and at that time We were looking at the nose structure in particular, so we have a nose structure here. If you don't know what a nose structure is, then I have a video on my website about this particular structure. You're welcome to go and check it out. But usually when you have a double top or a double bottom, or you have one of these kind of M and W structures, that nose area tends to provide significant support and resistance. This is something that we've been trading for absolutely years and years, and you know what, it's still going. So maybe it hasn't become a popular enough structure yet to fail, although I do suspect one day it will be. In any case, we saw this support being established at the nose somewhere between 52.40 and 52.80 on GBP AUD, and the last time we were looking at this instrument, the price was around here somewhere, and our expectation was that she would continue to break north. She ended up rallying to the tune of 350 odd pips over the last couple of weeks of December, and she's fallen back down to this area now. From a technical perspective, support is support until the support is breached. Where the price is now, it would not be unreasonable to be looking for a technical long on this instrument. But one of the considerations which I'm having is that if we're looking at it from a momentum perspective, this last fall from 56.80 down to where we are here, 52.80, she's fallen about the tune of 400 odd pips. And if I see this momentum continuing through this support area, then anywhere once she's broken down below that support, this instrument does become a blind sell. And if this area has been support, then I would suspect that she would turn resistance once the price has made its way through that, which would actually give us better risk definition than looking for the longs at this particular level and looking for the support to hold. The reason for that is that if we're looking for this support to be holding, if you want to exercise just a little bit of caution, let her break a little bit north first, let her establish some form of support structure and use that support structure to give you your risk definition. But what will have happened is that at least the price will have moved a little bit in your direction first, right? That's the kind of key and critical issue here. So if I'm buying, I will let her break north just a little bit first to give me that confidence that the wind is going to be in my sails, and I'm seeing some kind of support structure established. I can get involved on a long, but my expectation, actually just looking at the most recent momentum which has developed, is that she could very well end up breaking through that support. If that happens, I will look for this support area to end up turning resistance, and then look for a continuation to the downside. I know there's a little bit of a gap here at near the yearly open. I can see that too, but I'm really not too worried about it. If I see price headed in that direction, at that point it would become fair to assume that the gap is going to close. As long as the price is headed away from there, we will continue to assume that she can head further away from that level, right? So she's at a kind of key critical level here. It's an established support. It's a support which is established on a nose area, but that is now being tested for about the fourth time, and I would very much suspect that if the price does end up breaking through there, then it will give a very reasonable continuation trade to the downside. So that is something else I'm going to be keeping an eye on. Okay folks, that's your lot for this morning. Those are the trades that I'm considering. So particularly I've been on the case with Euro GBP and the Pound Swissy for a while, and as long as it's paying the pips, I'll continue to stay on the case. GBP AUD again, very much on the radar. When she swings, and there's a lot of pips to be made. There's a lot of pips to be made here, so definitely worth keeping an eye on. And after that, if you're looking at any pairs, I guess the yens will continue to excite. Anytime you see those breaking north, if you see the week turning positive, the year turning positive, the month turning positive, then be a buyer. If she's falling, I would assume that fall to be corrective in nature in the first instance, particularly until some form of resistance structure is established on those charts. Thanks very much for attending this morning. That really is your lot. Of course, thanks to the team at FX Street for providing this platform. I'll be back here next week. You can pre-register on the FX Street website. I do believe they send you out a reminder email and stuff like that, just to let you know the presentation is happening. And if you do have a moment, if you've not attended one of my presentations before, and you've been sufficiently wowed by the discussion, then take the time to check out my website. It's www.tradingwithdeadlyaccuracy.com. The short URL is wmdforex.com. It will take you there, and I'll see you all next week. Thanks again for attending.